We are all over one of the biggest and most controversial IPOs in years. On Groupon's first day of trading, shares soared, closing up 31%. Let's bring in two of our regular Groupon watchers, Paul Kedrosky, Bloomberg contributing editor and author of the blog Infectious Greed out in San Diego. And here with me in New York is A.B. Mendez, senior research analyst at Greencrest Capital, who has been covering Groupon for a very long time now. Plus, our editor-at-large, Cory will be with us in Chicago. But A.B., let's start with you. Your reaction today on this first day of trading. Do you think it could have gone higher?
It could have gone higher. I kind of had predicted that it would look a lot like LinkedIn's IPO. In the end, it was a little bit more like LinkedIn Light. Not quite as much volatility, not as much, not as high highs or as low lows as the first day of LinkedIn. I thought it would double, finish up 50%. It finished up only 30%, but they did move the range, so it finished 45% above the high end of the initially indicated range. So pretty solid performance, I think.
Paul, how about you? What's your take on this? You know, lots of people out there thought this would go even higher than it did, despite the fact that there are lots of questions about Groupon's business model.
Yeah, check the tapes. I'm in there. 50% pop, I said, and then closed somewhere below that. So, you know, this was more or less what I sort of expected from this thing today. And so, you know, a little less volatile maybe than the LinkedIn offering was, but it's worth pointing out, I think John Ehrlichman made the comment earlier on that that LinkedIn was a comparably small float. That's not actually true. This was, you know, almost half the size as a percentage of total shares outstanding, Groupon versus LinkedIn. So, you know, we, in theory, should have expected an even bigger ride for the stock, and that we didn't get it tells us about, you know, some of the nervousness that's still out there, I think quite rightly, about this thing. By the way, your interview was probably the strangest thing I've seen on TV in some time. I felt like at any moment Ashton Kutcher was going to pop out and tell us we'd all been punked on this thing.
You know, Andrew Mason certainly does have an interesting sense of humor, and the big question, of course, is can he be a public company CEO? Let's head out to Cory now. Cory, you know, Groupon's still up 31% today, but how long can Groupon keep this up, this ride?
Well, look, if Morgan Stanley sold all those 35 million shares to their best accounts and didn't get a pop in the stock, those wouldn't be great Morgan Stanley customers anymore. So they needed to have some kind of pop. I think that the change in the first day doesn't really matter. What's going to matter, and frankly, the trading of the stock isn't going to matter for 180 days until the insider shares are released. It's got some real float to it, and we can see how the market views the valuation of this company. You know, we've talked about it quite a bit, but the company doesn't make money, and the company doesn't create cash in any meaningful way. And the company has tremendous amounts of, you know, essentially debt, these payables that they have to pay out to the merchants, that they're stacking up at this company. It's a time bomb sitting on the balance sheet, and they're going to have to pay it off. Now, they've got some more cash to do it with, but the company's not generating enough cash to do that. If they don't get that problem fixed, we're not going to be sitting here talking about Groupon 10 years ago. Someone said in our show earlier, another show earlier, that this was the web van of our era, and web van might not be one you remember, but it was a Goldman Sachs deal. It was highly touted, highly touted. I remember analysts taking investors through their fancy warehouses and how great Webvan was going to be, and it's gone. It was a zero. And so, you know, where Groupon's going to be in the future, I think, is still quite a big question.
Strong words. Cory Johnson, AB, you've been much more positive about Groupon. Do you agree? Is Groupon the Webvan of our era?
I actually did a consulting project at Webvan's headquarters, I guess Palo Alto, I don't remember exactly. I can say from experience, no. Webvan never generated really meaningful revenues, never got much outside of the Bay Area. Groupon's in 45 countries, you know, has about $1 billion of cash sitting on the balance sheet right now post this IPO, and is already cash flow positive on an ongoing basis. So, well, people will say this is a small float. It's small only on a percentage basis, because 5% of, you know, 12 billion is a pretty big number. 700 million compared, it's more than double the size of LinkedIn's IPO in absolute terms. So I would disagree with that comparison. Another thing to say about Groupon is that it does make the first and second quarter of 2012 more critical, as Cory mentioned, that 180-day lockup expiration for early holders. So they need to execute on that first quarter. 4Q will be easy. First quarter will be more of a challenge, both in terms of performance and sort of setting up ahead of that lockup expiration.
Paul, what is it about Groupon? Why do some people out there think this thing is going to go down in flames, and others are so desperate to be a part of it?
Well, I think it's got all of the pieces that turns into a great retail story, which makes people want to be a huge part of it. This feels like a seismic change in the way we buy things in modern economies. We're buying things through this kind of continent-wide or even worldwide discounting service that gives you easy access to products, and it feels like a way that it could transform purchasing. And so those kinds of big tectonic changes often lead to great investments. I think what rightly worries everyone are all the signs that this business is a huge cash consumer that will decelerate rapidly if they change how much money they put out in marketing dollars, and they rapidly exhaust their customer base and are forced to continue to spend heavily. So it doesn't make it a dying business. It just means it's a business that's very expensive at its current valuation if we see the deceleration we saw in the last quarter continue. And that's the root problem for the company. It is very expensive for what we saw last quarter if that turns out to be the future of the company.
Cory, where will Groupon be trading a year from now?
Well, I think that Avi brings up a good point. I mean, these guys, they changed the business model to make the IPO look better. They may change the business model to make 180 days from now look better so the insiders can get their shares out. But, I got to say, Avi's point that they're in 45 countries and that they've got, so many customers. I mean, they lose money on every sale and they're not making it up on volume. And that's what's going on here.
All right, Cory Johnson, our editor-at-large.
I'll take that number, though. $15. $15.
$15. Paul Kedrosky, AB, you want to weigh in? Where's Groupon going to be trading a year from now?
About 10% up from here. It's traded up enough on the open that it's where I put it a year from now, basically.
Okay, so
already.
about $28.
I will say I dare you to short it into the fourth quarter earnings. I've tried shorting small float stocks. Even when they miss, they go up sometimes, So, yeah.
I don't know if I'm going to take that dare, but thanks so much. AB Mendez of Greencrest Capital, Paul Kedrosky, our Bloomberg contributor in San Diego, and Cory Johnson, of course.